economy falling this extent is not unforeseen. Yeah, so people probably already know about it. As I shared, the earnings, the expectation is for it to be falling 44% in the second quarter, 2020. So all this, when it's expected and it comes out like that, it will not move the market. Market move based on expectation. It move ahead of reality. Yeah, so I said, if waiting for, if because of the 42% decline in GDP, and you think that will be a cause for market to correct, I don't think that will be. It has been expected. At this moment, to be overly invested or under-invested are both. Being over-invested, why? Because I said it's a plastered war. Plastered, a war that's broken, plastered all over. Yeah, it's holding very well, because the Fed has one big giant plaster which is exceptionally strong. So if the Fed continue to keep that plaster there, it may not be likely for that war to be broken. Yeah. However, I say, if some of these plaster are being taken away, we do run a risk. Yeah, especially if inflation were to be raging. I don't think it will be a very near term, but in the longer term out, let's say a couple of years, that could happen because of this mass printing of money. I'll say, yeah, so being over invested means, if the stock market drops, let's say another 30-40%, your portfolio firstly will be volatile, and you got no money to buy stocks where prices are much lower than today. That's the risk of being over invested. How about being under invested? Given such a dim economy, such a poor economy, shouldn't it be safer not investing, putting all my money in cash? As I say, you run two risks. The first risk, if inflation were to rear its head because of this massive printing of money, then you will face a prospect of whatever money you put in the cash, in the bank, depreciating quickly. And secondly, if you decide to buy stocks at that point of time, because I think in the near term, especially, maybe the next 10 years or so, we are in a situation of low interest rates and a lot of money chasing a small class of good quality assets. And in such a situation, it's in fact the pressure for the price of this class of assets to go up is actually very high. Especially if you remove this COVID-19, it could really jump up. And furthermore, some of these companies, their earnings keeps increasing over years, and their share price will increase over years. So if you keep waiting and waiting, we may end up, we never, whatever we are waiting for, never ever materialize in our lifetime. Then I think it'll be a bit of a futile effort. So currently, I say my own portfolio, I'm about half invested. That is a percentage I'm comfortable. Yeah, and with gold and cash, as the remaining. I'm not suggesting you to do the same. I think everybody should personalize their portfolio based on their own tolerance for volatility, their financial situation. I don't advocate you to just follow me. I really encourage you to speak to somebody, or at least if you prefer to be DIY, then at least have an understanding about yourself and have understanding about about assets, the volatility of assets. Okay, the last part about Singapore is, as I said before, 80% or more of Singapore companies are cyclical growth companies. Cyclical growth companies are companies that need economic growth to grow. And I don't think economic growth is going to surface anytime soon. The last 10 years has been the slowest post-recession growth after World War II. The next 10 years, I think, will be more of the same or worse. So in this kind of situation, cyclical growth company is not going to take us anywhere. So I think I would really encourage, or not say encourage, I would say I would not invest much myself. And that's true for myself, right? I really don't invest in much Singapore companies myself. And if we do, then I think we'll be selective, because there could be a lot of value traps.